Hello, this is Rajat Bose here. We are coming up with our 13th issue of stock recommendations, stock reviews and market outlook. Market outlook comprising Nifty, Bank Nifty and cnxmidcap. This time we are coming up with more stock reviews. Since this is the result season, there has to be some more stocks coming in. This week, the foregoing week, the last week of July, there has been quite a big movement with ITC, with lots of other stocks. So Nifty also, it has given different types of movements throughout the week, yet maintained its stance, that is the bullish stance. We are going to see whether the bullishness continues or there would be some threat to the bullish stance of the Nifty. I have introduced one chart which I do not normally use. We are in the month end, so I'm using the monthly chart, and there is an interesting development on the monthly chart that I would like to focus on. Look at it, that is around 2008, you found that the peak and the 14 RSI was coincidental. There was a lower peak in 2010, but a higher close for the Nifty, yet we saw that there was some kind of a correction, a sustained correction for some time, for several months, and then from 2012 to about 2015 there was a good upswing, and that upswing when RSI went close to about 80 kind of levels, there was a correction. Finally, we saw that a higher peak around this 2018 or even later, close to about 2019, there was this peak which is around, it was in 2020, it was February 2020, from a high that was, I think, 12,000, close to about 12,000 levels. From there was a big fall. It was 12,500, and the fall took the Nifty to 7,510. That was the level recorded on 23rd March 2020. So the negative divergence coincided with a sharp fall. Why am I referring to this 14 RSI and the negative divergence? Now look at it. The October 21 peak, 18,887, that peak and the high in the 14 RSI coincided. So there was a 6-month-old correction, and after that the market started moving up again. First it almost scaled up to the same level, then it came down, and again this time we have seen on 21st July, we saw a high of 19,991. This is a sharp rise. This is a higher peak, while the 14 RSI on the monthly chart has not gone beyond even the 70 mark. This suggests that there is going to be a sharp fall, a sustained fall for quite some time, for several months. That will happen, and that will be pretty damaging. That will be at least it is likely to retest 16,000 or 15,500 level. That level can well be seen on this. So my suggestion is that if you are making good money, you better start taking some profits. I'm not saying that the very next month the fall will begin. That cannot happen. That is also not ruled out, but at the same time that will happen the very next month, that is in August 2023. I'm not saying that it can happen even it can happen even the next year, but whenever that happens, that would be pretty damaging, that is for sure. So it would be better to actually put some money off the table. I have not used the weekly chart. I have used the monthly chart. You have seen already. Now this is the year to date chart, daily chart at the end of 28th of July, Friday. This shows that over the last 7 trading sessions, 4 or 5 trading sessions had been down days. It had been down days. Only 2 days we saw that actually we saw higher closes. So there is some bit of weakness, and after 23rd June, for the first time, the daily chart, on the daily chart we see the test of 20 unit moving average. My guess is that we might see an attempt that might be made to move up, and that would be resisted around 19,700 to about 19,710. It, for a minimum, it needs to stay above that. Unless it does, it would again come down and breach the 19,577 20 unit moving average, and it can go further down below that. Finally, I'll show you the 15-minute chart. 15-minute chart shows that after the huge run up to the 19,991 high on 21st of July, what we see here is this, that we have the market has been falling, and the 50 unit moving average on the 15-minute chart for the better part of 21st to about 24th, this level was not, this moving average was not taken out. It was taken out only a later part of 25th, and again it failed. So again it is testing at the end, but it is here the 200 unit moving average is around 19,700. So this is unlikely to be breached. Better be cautious. Unless it sustains above 19,710, expect a fall. The week before last, the Bank Nifty posted a new high. After that, the Bank Nifty is again struggling. It is as if the major contenders like HDFC Bank and others are not performing to the expectations of the bulls. So Bank Nifty is again giving some kind of a sideways volatile movements throughout the week, so we need to study them. We would be applying various types of charts as well as pattern studies, so that what exactly is coming from the Bank Nifty, we would study them in detail. The Bank Nifty chart shows that there was a high at 46,369, and there was a lower high on Thursday, which was a bearish engulfing day. We will see that very soon on the daily chart. This is the monthly chart. Here we see an inverted hammer formation. This suggests that there is likely a fall waiting for us, but this fall, if 44,500 gets taken out, only then expect further fall. In that case, 44,000, 43,300, 43,000, these would be the support levels for the Bank Nifty. Now Bank Nifty is also showing some kind of a weakness that we have already mentioned, and let's just see how does it look like on the 14 RSI chart. 14 RSI consistently giving negative divergence for the Bank Nifty. 14 RSI is showing that even the Bank Nifty, just like the Nifty, is vulnerable for a fall. Now if we look at the Bank Nifty 15-minute chart, you see that Bank Nifty on the last day, that is 28th of July, it tested the levels of 45,238. From there was a recovery, that was a 220 point recovery towards the end. However, one thing we can see is this, that Bank Nifty, there would be a good bit of resistance between say 45 600 to about 45 700. Unless it takes out that level, there is it would be very difficult for the Bank Nifty to move further up. Suffice it to say that 45 730 is the key resistance zone or the key resistance level. Bank Nifty needs to sustain above that. If it does, then it can show some kind of an upswing, and higher levels might be seen. But going back to 46,000 plus now looks slightly improbable. There could be further fall waiting for Bank Nifty. Coming to 125-minute chart, here we are using 125-minute chart to show you that there is a bullish engulfing pattern, and it is also the 50-unit moving average. So the bullish engulfing pattern at the bottom suggests that there would be an attempt for a bounce back again, and that bounce back might show that the range between say 45,648 and 45,880. So 45,650 to about 45,880 would act as a supply zone, but let it first cross 45,730 and sustain above that. Only then we can think of 45,880 or something. But one thing is very, very clear: at higher levels there would be some selling pressure. There is likely to be some selling pressure. The mid caps and the Nifty, they are actually pretty much okay. I mean, their performance is still good. 20-day moving average has not been broken decisively. In fact, it has not been tasted as yet. So we need to see how long this bullishness in CNX mid cap continues. Of course, intraday volatility, day volatility, that can be there, but the overall uptrend that began from April still continues. We are using two charts out here. Initially the daily chart and then the monthly chart. The daily chart shows the strength that CNX midcap has been exhibiting. The weakness that you have seen, they were limited to the Nifty and the Bank Nifty chart. At least on the daily chart, there is no such signal on the CNX midcap that it is showing any kind of weakness. In fact, it is still continuing to be moving within the 9-day exponential moving average, which is purple colored moving average, and the Bollinger Band, upper Bollinger Band, which is the +2 standard deviation band for CNX midcap. These two are encapsulating all the price activity of the CNX midcap, and it is going up and up. The 9-day has been tested quite a few times, but now it is again testing or again touching the upper Bollinger Band. So CNX midcap after a few days has gained its bullish momentum once again. So on the daily chart it looks pretty positive. So that's how in the short term we may expect the CNX midcap to continue moving up. Now what we do is that for this index also we are taking a larger perspective using the monthly chart. On the monthly chart, as you can see, this is the lifetime chart of the CNX midcap. Whenever I show the monthly chart of the CNX midcap, it is the lifetime chart for it. And this lifetime chart shows that the CNX midcap in the month of July or towards the end of this month, it is already testing the upper arc. One such arc actually acted as a resistance in 2021, 2022. Now in 2023, for the first time, the higher arc, the orange color GAN arc is already there. The prices have moved close to that. 37,357 is the last close. It has reached there. So even if the daily chart shows humongous momentum. We can say that the 14 RSI has not yet made a higher peak than the earlier peak. So 14 RSI is currently 74.51, the last count, and when it posted the higher high in 2021, it actually moved up to 82.03. So there is still about 8 points to gain for the 14 RSI monthly to level the high made in 2021. If this high is not made, and if the arc really acts as a resistance, then there is a possibility that even there will be some profit taking in the CNX midcap. So CNX midcap on the monthly chart suggests that a break might be applied on the movement of CNX midcap, but for the short term or intermediate term players, there is no such sign that CNX midcap immediately is going to go down. If you look at CNX midcap daily chart, you will notice that CNX midcap, the 9-day exponential moving average is at 36,929. So it is now at 37,357, and that moving average is at 36,929. That means 428 points lower. So only when you see the 9-day exponential moving average gets decisively violated, at least for 2 to 3 trading sessions, then expect some kind of a fall. Otherwise, there is no fall that is expected in the CNX midcap. If you have liked my presentations, press the like button. Subscribe to my channel. Also press the bell button so that you get notifications from YouTube whenever I post a video. This time we are trying to cover a number of stocks. We quickly review stocks, not just those that we have already given recommendations on. There will be other stocks also if they are worth discussing. So keep on watching. Our first stock under review is ITC Limited, and we are again using the same monthly chart. And here we see that in 2017 ITC peaked at 294, and from there its correction began, and in between there was another attempt to move up, and it went up above say 250 but could not sustain. And finally the COVID-19 March 2020 it tested the level of 111. That was the low for ITC in this decade, and ITC after that never looked back. ITC started going up from 2022, early 2022. ITC started moving up. In between only for 2 months it showed a lower close, and that happened in November and December of last year, that is 2022. ITC for the most part is going up like a skyscraper. ITC is moving up. ITC finally closed this week at 468. Now one thing needs to be said here is that ITC, unlike Nifty, Bank Nifty, or several other stocks, even CNX midcap might show a negative divergence on 14 RSI. This is one stock, despite such a humongous bull run in the stock, the 14 RSI is not showing any negative divergence. 14 RSI for ITC is now at 88.41 on the monthly chart, and this is its highest ever, at least since 2004 or so. This level ITC could never reach on the 14 RSI. So there is no negative divergence as such. But can ITC correct? Yes, there is a possibility that ITC might correct, but if it were to sustain above say 475 or 476 to be precise, then it can move and go beyond the high posted at 499.60. It can even scale up to something like 521. But ITC from another parameter looks like it is a bit overbought stock, in the sense overvalued stock. In fact, Hindustan Lever was valued at 6,05,000 crore market cap. ITC's market cap is about 5,85,000. That too not on the last 2 days. Prior to that, whatever was the ITC's level, based on that, the market cap at that point of time was only 20,000 less than Hindustan Lever's market cap. So from that perspective, we would say that despite the fact that ITC makes a lot of money, huge money, in fact, quite a big money in cigarettes, and its FMCG division is picking up, its hotel has been demerged, all that is fine, but it is even from the point of view of valuation, it looks a bit stretched. And ITC management hasn't done anything as such for the large amount of cash that is lying there on their books. Hotel has been demerged. 60% would be going to the shareholders will get shares for 60% that would be there, but shareholders being ITC shareholders, ITC would retain 40% of ITC hotel stake because it is the promoter. There is nothing to take an issue out there. To support ITC hotel, ITC would retain a promoter stake. That was quite understandable, but the huge cash that they are not utilizing to the hilt, the kind of return that they generate from other divisions and kind of return that is they are getting on that cash, this is very disconcerting for shareholders. At least the shareholders could have been given special dividends, and they could have deployed that money elsewhere to generate high returns that ITC normally generates, maybe from other avenues, but ITC didn't do that. My take on ITC is that one should book profits and get out of it. If you have to remain in ITC, wait for a correction. There will be a correction sometimes. This kind of a one-way up like a multi-storied building, this kind of movement will not sustain. So be patient. After booking profits at lower levels, you can re-enter ITC. At least I would say that let it come down to the level of 9-month moving average, which is around 400. At that level, ITC can be repurchased again, but not at current prices. Our next stock under review is Hindustan Unilever. Again, we are using the monthly chart here. In this monthly chart, just as I said in case of ITC, ITC is the only stock where on the monthly chart, despite rising in such a huge manner, it was not showing any negative divergence. On the contrary, Hindustan Lever, right from late 2019, on the 14 RSI monthly chart, it continues to show negative divergence. Yet it is going up. This negative divergence doesn't mean much then, because it has been going up and the RSI is going down. But the only thing that we need to remember is this, that this kind of movements that you see in the monthly chart, and when even 20-month moving average was tested only once or twice throughout this journey from 2017 to current date, so last 6 years. Only once it tested the 50-month moving average. Again, the same thing for 20-month moving average. So this also looks a bit top heavy. Some kind of a fatigue might be seen unless Hindustan Lever takes out 2800. It is unlikely to move further up, and around those levels there could be, you can expect a lot of supplies. So this one-way traffic that we have been noticing in the stock market, this is unlikely to sustain, even though the Fibonacci target that on the monthly chart shows 3041 at 3.618 level. That is, at least in the shorter term, maybe in the next 6 months to 1 year, I do not think Hindustan Lever will go to those levels. It's already 6 lakh crore plus valuation. Given the kind of growth in sales and other things in earnings Hindustan Lever is showing, I think here also some kind of a correction is in order, and in that correction I am expecting something like 2250 to about say 2100. So those kind of levels, maybe you can think of re-entering. Part profit booking is definitely warranted. I'm not saying that you sell everything, but at least part profit booking should be done. Third stock under review is HDFC Bank. Again, we are using the monthly chart. Here what we notice is that, yes, even in this monthly chart, for the last few months, HDFC Bank has moved up, volumes have grown. So this is definitely a positive thing. But yet, one thing must be observed, must be taken note of, that is currently at 1643. Unless it takes out its high of 1757, it is unlikely to show major strength. On the contrary, if it were to fall below the 1600 level, where the 9-month moving average, 9-month roughly corresponds to 200-day moving average, if 1600 level were to be taken out, then you should at least book some profits here. And there is a possibility that it might even test 1500 levels, but prior to that 1600 should be broken. Only when it negotiates with the 20-month moving average, you can think of re-entering or getting out of it even more. That below 1600 you should book part profits, and below 1500 more profit should be booked. Only when you see it stabilizing around, say, between say something like 1300 and 1500, then I think it would be a much safer buy. It isn't as if it can't move up, but the point is that even 1 month up, next month down, 1 month up, next month down, these things tend to happen close to the top. So even this stock, although it has corrected earlier, even this might correct. So it is quite overstretched, and one needs to wait for lower levels to buy. Otherwise, even this stock can be a bit risky. And while you may not lose money in those stocks that have moved up almost vertically, this is not that kind of a stock. But yet, in the immediate term, my feeling is that it is unlikely to move much further up from here. Even crossing 1700 levels or 1750 to about 1800 would act as a major supply zone. So booking part profits here may be warranted. Below 1600 you should book more. Only when get a level of around 1400 to 1500 for this stock, that would be a much safer buy. If you have liked my presentations, press the like button. Subscribe to my channel. Also press the bell button so that you get notifications from YouTube whenever I post a video. Again, we are coming up with 2 stocks. This time, maybe we are not getting into the mainstream stocks, in the sense that those stocks that had been performing, maybe software or say banks or others, not that. It could be metals, materials or commodities. Let's see what we come up with. You would be benefited with that. Ashok Leyland, our first recommendation to book profits. This stock looks pretty top heavy, and there is a red candle at the top. Tried to sustain above 185, could not do it. Finally closed at 179.30. It can't move up Further, we cannot rule out that, but the reason behind I suggest booking profits is the simple thing is it is more than 7-8% from the 9-week exponential moving average, and the rise is pretty much vertical, and one Fibonacci suggests that 2.618, that is from a higher base, the target is 193. From another Fibonacci projections, the level is coming at 174, so it has moved beyond that. It would be better to book at least part profits, because from both the Fibonacci projections we see that 193 to about 197 would be the range that we can envisage as of now. But whether it will really move up before giving a substantial correction, the advantage here is that if you book part profits, you can re-enter at lower levels. My take is that it is likely to test the range between say 170 to about 175 or 65 on the downside. Around that time, if you re-enter, that would be better, but at least booking part profits is warranted. Our second and final recommended stock for this week is ACC, the cement manufacturer. The cement manufacturer has given a breakout. It has given a breakout above the 200-week moving average, and it is testing the 50-week moving average, which is located at 1962, and it has closed at 1948. This time it has actually moved beyond that, that is 1974, and moving average, the 50-week moving average was at 1962. So it did go beyond that, couldn't close above that. Close is very near, that is 1948 at the end of the week. Looks pretty good. In fact, if you look at the YTD chart now, the YTD chart shows a lot of YTD chart shows clearly that it is negotiating with the 200-day moving average. There is a doji around that level on Friday, and for the whole week ACC started moving up. It has formed a base. It is showing RSI above 70, momentum has come back, and it has consolidated, or rather shown some accumulation, base formation, supply absorption for so many months. Since February it has been doing that. Now only it is posting a breakout. So after forming a base, if it is moving up, it is headed for higher levels. So ACC is going to go up. Now the initial target would be something like 21-24. After that, the next target would be 22-48 or 49. We are projecting ACC to scale up to 24-31, and this is our 1 year target for ACC. Roughly 20-25% kind of a move on the upside we can envisage. ACC is a buy. If you have to put a stop loss, please put that stop loss below 1750. So 200 point on the downside, 500 point on the upside. That is the kind of trade. You are taking a 2:5 trade out here. Duration will be 9 to 12 months. It can go up there much earlier, but we suggest that you hold it for say 9 months to 1 year, and chances are that the stop loss would not be hit and move to that level around above 2400. I thank you all for watching. Thank you very much. Please watch this video again, share it. Again, I invite you to come next week as well.